या शुभ्र वस्त्रान्विता या वीणा वरदण्डमण्डितकरा या वीणा वरदण्डमण्डितकरा या श्वेत पद्मासना या ब्रह्माच्युत शङ्कर प्रभृतिभिर्देवै सदा वन्दिता या ब्रह्माच्युत शङ्कर प्रभृतिभिर्देवै सदा वन्दिता सा मां पातु सरस्वती भगवती निशेष जाढ्यापहा निशेष जाढ्यापहा निशेष जाढ्यापहा
So, Madam, with the permission of the speaker, I think it's 6 o'clock and we shall start the program.
Yes, sir. Please start.
Good evening, all of you. You are welcome to this second day of the virtual meeting on what's new. Yesterday, we learned about what's new in GST. Today, it will be the turn of income tax. We are joined by CA Chundur Sudhir, who is an expert in direct tax as well as indirect tax, and he is a member of Vijayawada branch and also an SOS speaker and also a faculty for Vijayawada branch. He is associated with the Vijayawada branch for the last several years, and his contribution to Vijayawada branch is immense. Friends, we shall start the proceedings with our motto song. We need not stand, but we can place our hand on our heart as a mark of respect. Let me play the motto song.
Yaesha supteshu jagrati Yaesha supteshu jagrati Kamam 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 kamamsho pursho nirmimanaha tadeva shukram tadbrahma tadevamritamuchyate tasmin lokaha shataha sarve tadunatyati kaschan etadvaita
Thank you. Friends, I request all of you to type your name and membership number in the chat box in order to mark your presence in this virtual meeting. Madam, over to you for your opening remarks.
Yes, Speaker C. Chundur Sudhir and colleagues in the Managing Committee and past Chairman C. Godavarthi Srinivasrao sir and fellow members, a very good evening to one and all. And as we are into for filing of individual returns and tax audits, we should equip ourselves with the latest amendments and reset provisions in income tax and GST, and so that we can provide better service to our clients. And this contest, we have planned this BCM under the name What's New. Yesterday, we had a wonderful session by our speaker, CF Kumar sir, on the updates on GST. Today, our speaker, Chundur Sudhi sir, Sudhir Garu, as our Secretary Nita Ravkishar said, he is a regular speaker for our Vijayawada branch. And we have very positive feedback from our members about him. As when a session on amendments and very complex provisions, when we listen to Sudhir Garu, it will be very easy for easy to understand, and without any further dates, it will be get clarified as we heard from many of the members. So because his explanation is in such a easy, understandable way, and he is always ready to serve Vijayawada branch in any aspects. Thank you so much, sir, for that. And again, dear members, Vijayawada branch, you all know Vijayawada branch has released AR scheme for the year 2022-23, and guidelines and payment links are shared to your mails also. And the response till now is so good. And those members who have not paid, I request all of them to pay for the same. And you can join, even though we have given specific number of CP hours for that, you can join throughout the year for all the knowledge sharing programs without any further fee. And we always promise you that we will conduct extensive number of programs for the benefit of the members. Thank you, one and all. Happy learning.
Yeah, thank you, madam, for those words. CA Chundur Sudhir is a chartered accountant by profession. He has been consistent topper at school and college level. He has completed both chartered accountancy course and cost accountancy course at a very young age of 21. He was All India 6th ranker at a final level and also 43rd rank holder in CMA. He has received a Pratibha Award from AP State Government in intermediate examinations. He is the district first ranker in the intermediate examinations. He has given various GST seminars for accountants and chartered accountants at Vijayawada, Ongole, Elur, Vissanapet, Tiruvur, and Machilipatnam. As of now, he has presented GSTR 9 and 9C seminars more than 15 number of times. He has taken CP lectures at Vijayawada, Elur, Guntur, and Kakinada branches of ICAI of SARC. Also, he deals with the direct and indirect taxes. He is a faculty for direct and indirect taxes to CA and CMA final students for the last 6 years. And also, he has taught for more than 3,000 students by this time. He is also presently a member of the Indirect Tax Committee of AP Chamber of Commerce. Over to you, Sudhir Garu, to take this seminar forward.
Yes, sir. So first of all, I thank Vijayawada branch of SAIC of ICA for giving me an opportunity to have a discussion on a special topic, what's new. So even though usually we cover amendments, but what's new? The title itself gives us some anxiety. So simply, rather than saying amendments of income tax, amendments of GST, so a special title called What's New. So that the title actually creates an anxiety in us. So now let us begin with the topic What's New in direct tax. So from the past 2 to 3 months, what are the various provisions that has come in Income Tax Act, so that we shall provide service to our clients, whether any new returns can be filed or not, what are the changes that has come in new ITR forms, and those aspects and the amendments which has come, those aspects, let us have a discussion. So first, let me share you the screen. Yeah. Yeah, sir. Is the screen visible?
Yes, sir.
Yes, sir. Yes, sir.
Yeah. Okay. So now the PPT, this presentation PDF has already been shared in chat box. So now, with no loss of time, let me begin my discussion. And from the past 1 month, around whenever the budget has been released itself, even from February itself, the government has specified that we can file an updated income tax return. So whenever we listen the term updated income tax return, immediately we get in mind who has to file this return. They are saying that past 2 years, even though the due date and belated return time period is also expired, even though the due date and belated time period is also expired, we can file income tax returns for the past 2 years. So how is it possible? What are those provisions? So this concept is in mind. So now let us begin this aspect in a detailed manner. So first one, which section of the act contains these provisions? First of all, what do you mean by the term updated return? That let me have a discussion first. Sir, here updated return means past 2 assessment years after completing the assessment year. For example, if you take assessment year 1920 as example, sir, assessment year 1920, that means financial year 1890. The due date, and even if we consider belated period also, before the end of 31st March 2020, assessment year 1920, sir, that means financial year 1890. So maximum we have to file before 31st March 2020. Of course, there might be some extensions and all due to corona situation. It's a separate thing. But if the due date has been expired and the belated time period is also expired, that means if we take recent assessment year 21-22, so till March 2022, we are in the process of filing the returns relating to assessment year 21-20. So the final date, the last date for filing, even though due date has been given as March 15th in some cases, February 15th in some cases, that's a separate thing. But maximum time period before 31st March 2022, we have to file income tax returns relating to assessment year 21-22. If we didn't file, so today, now, can I file income tax return for assessment year 21-22? Not possible, because the belated return time period is also complete. That's why even though any client comes to us to file, sir, last 2 years returns, please file and give us acknowledgements. We have to go for loan. Even though they ask us, we were unable to file because the portal does not accept. Because that belated return time period is also completed. So in such cases, wherever the belated time period is also completed, we have another chance to file updated income tax return. That the acknowledgement and also the form, that is nothing but ITRU, has been specified. So for how many years we can file this one? So first of all, is it legal? Yes, it's 100% legal. A section called 139 subsection 8A, Finance Act 2022. Finance Act 2022 has introduced section 139 subsection 8A in Income Tax Act regarding this updated return. Who has to file this updated return? Any person. Person may be individual, partnership firm, HUF, company, association of person, body of individual, trust, cooperative society, artificial, judicial person. So all these were in person definition. Any of the person can file this updated return. When in case where there is error or omission, two things has been specified here. Error or omission. Sir, error means we have filed the return, but in return there are some mistakes, there are some errors, or omissions, some incomes we didn't disclose. So in such case, can we file this updated return? Yes. Sir, what is the difference between revised return and updated return? Sir, revised return also, we have to, there is a time limit. Even in last year, if you see, by 31st March 2022, you should have filed revised return also. Any mistakes in the original return. But now, can I file revised return of assessment year 21-22? No. Then what I have to do if there are mistakes in assessment year 21-22 IT? I have to file updated return. So even though you have errors or omissions in the original return filed by you, or sir, original return I didn't file at all. Original return you didn't file at all. Now can I come for this updated return? Yes, you can file. Here if you see the reasons for filing ITRU. Sir, ITRU means stands for updated return. Reasons for filing ITRU, updated return. U for update. So who can file? What is the reason for filing this ITRU? Return previously is not filed. Even by 31st March also, SSC didn't file his return. Now he has found some transactions were there in AAS and TAS. Now can I come for this updated return? Yes. Even though return previously is not filed, or another thing has been specified, income is not reported correctly. That means I have already filed income tax return, but income I didn't disclose properly. Can I increase the income? Yes. Under which head of income? Any head of income. You can increase the income, but you cannot decrease the income. Sir, this ITRU is not for the purpose of getting refund. This ITRU is not for the purpose of reduction of tax liability. This ITRU is only for the purpose of getting additional tax liability to the government. So if you want to get any refund, whether this updated return is possible, no. Only if you have a tax liability, then only you have to come for this updated return concept. So income is not reported correctly, or wrong head of income chosen. Wrong head of income. I have to disclose under the head capital gains, but I have shown it as business. Now can I change it? Yes. Reduction of carry forward losses. Reduction of carry forward losses. So carry forward loss, sir, you said that income cannot be reduced. Yes, but here if you see reduction of loss, not reduction of income, sir. Loss has been reduced. So loss has been reduced means nothing but profit has been increased. Generally 8 lakhs loss carry forward. ITR he has filed, but actual loss is only 2 lakhs. Now can I reduce the loss? Yes, because in future your set off will get reduced. Automatically income increases to the government. So to reduce the carry forward loss, can we file updated return? Yes. Or reduction of unabsorbed depreciation, because these are losses and expenses. In order to reduce them, can I file? Yes, because now if you reduce in further years, your income will automatically be more. That's right. Or reduction of MAT credit or AMT credit. In return of income, MAT credit or AMT credit, book profit computation or adjusted total income in case of AMT, I didn't do it correctly. Now can I rectify? Yes, using this updated return. Next, wrong rate of tax. Sir, once again, I would like to clarify that this is not revised return. Even now, revised return time limit is also completed. But if you have any errors or omissions in the original return file, now you can come to this updated return. But one thing to be noted, updated return has to increase the tax liability. It cannot reduce the tax liability. It cannot give you the refund. Others or any other reason. That means what I mean is any other reason, but your liability has to increase. In such case, you can file this ITRU. What is the due date for filing this ITRU? Sir, assessment year 13-14 return. Now can I file ITRU? No. Assessment year 17-18 return. Can I file ITRU? No. Here, if you see the theory, after relevant assessment year, but within 24 months. That means because till the end of the assessment year, we have belated return, no sir. Till the end of the assessment year, we have belated return. After completing this assessment year, 24 months time period you have. Let us take a simple example, sir. Let us take a very, very simple example. Can I file assessment year 1920 ITRU updated return now? Sir, assessment year 1920 means year ending date, assessment year ending date, not financial year, sir. Assessment year 1920. That means assessment year ending date means 31st March 2020. From there onwards, 24 months means 31st March 2022. The date is already completed. So then for which year can we file now? Whether assessment year 2021 possible? Yes. Assessment year 2021 means financial year 1920. Financial year 1920. Assessment year 2021. So assessment year 2021, what is the last date of the assessment year? 31st March 2021. From there onwards, 2 years, 24 months. That means 31st March 2023. Now we are in 2022 May. So that means, what can we do, sir, finally? Assessment year 2021 and assessment year 21-22. As of now, if we calculate assessment year 2021 and assessment year 21-22, these 2 years income tax updated return now we can find. So assessment year 19-20, 18-19, those years it's not possible. So for which year is it possible finally? Assessment year 2021, 21-22. Sir, what about assessment year 22-23? We can file original return only, no. So now recently the forms have been notified. We can file original return. For assessment year 2021 and 21-22, even though you have filed the returns, if there are mistakes because AAS, TAS has been updating, if you found any transaction there, now can I file updated return disclosing those incomes? Yes. Any errors or omissions, or earlier I didn't file return at all. Now there is a chance of getting notice. I have referred my AAS and TAS. Now can I file the return? Yes, you can file. Even though you didn't file earlier, or the filed return you have errors or omissions. Now we have an option to file this updated return. Now let us continue. For which assessment years is it applicable? Finally, we have taken a conclusion. Financial year 1920. That means assessment year 2021 and assessment year 21-22. For these 2 years only you have chance. And one thing to be noted, updated return cannot be updated again. So some confusion. Sir, updated return, once you file this updated return, if you have any mistakes in this updated return, can I rectify again? No. Updated return cannot be updated again. Sir, original return, if you see, revised return can be revised again. If there are mistakes, once I have filed revised return, can I re-revise again? Yes. But here, if you file once updated return, this updated return cannot be revised or updated again. Only once. If you see, a taxpayer would be able to file only one updated return. It was clearly stated in the provision. One updated return for each assessment. Okay. So next thing, additional tax. Additional tax. What do you mean by the term additional tax here? Sir, what is the normal tax liability? Based on slab rates we calculate. But here if you see, along with the normal tax, you have to pay additional tax also. How much is the additional tax? 25% interest. 50% interest. There is some slight confusion, I think so. But I would like to clarify this aspect with a simple example, sir. Very simple example I will give you. Assessment year 21-22. Let me take assessment year 21-22 as example. Sir, my income is 6 lakhs. Total income itself is 6 lakhs. I didn't file my income tax return. Actually, when my income is 6 lakhs, I have tax liability. I should have filed income tax return, but I didn't do so. Now can I file income tax return? Yes. Updated return I can file. Assessment year 21-22. So what is the total income? 6 lakhs. So in that 6 lakhs, sir, up to 5 lakhs, tax liability is 12,500. We all know. Greater than 5 lakhs, we have 1 lakh. 1 lakh into 20% comes to 20,000. Let us assume I am in old option only. 115 BAC I didn't opt. So I am in old scheme only. Old tax regime only. That's why my tax liability is 20,000 plus 12,500, 32,500. My tax liability is 32,500. So for which now I need to add education cess. So 32,500 into 4% education cess if I add, I will get 33,800. So 33,800 is my tax liability. But I am paying this tax liability in a very belated manner now. I have to cover this by way of advance tax earlier. But now, by using this concept of updated return, now I am paying this 33,800. for which 234 ABC interest will be charged. Let us assume 234 ABC interest has come to 10,000 rupees. Just for assumption sake, I am telling you. Tax liability is 33,800 plus interest. Let us assume 10,000, 234 ABC interest has come. So total 43,800. Along with this 43,800, 5,000 rupees late fee also must be paid. If earlier I have filed return, it's okay. But earlier I didn't file return. Now I am filing updated return. Whether late fee also will be levied? Yes. Earlier if I have filed return, now I am updating, then late fee will not be levied. If you didn't file earlier, now late fee will be compulsory levied. Let us assume I didn't file the return earlier. Now 43,000, tax 33,800, interest 10,000 plus late fee 5,000. So total has come to 48,800. Whether this 48,800 tax must be paid? Yes. Along with this 48,800, 48,800 into 25% additional tax should be paid. Sir, I have to pay, first of all, what tax I have to pay? That 48,300 I have to pay. Normal tax, interest plus late fee. On that amount, that 48,300 into 25%, that means 12,075 rupees. Additionally, I have to pay along with normal tax. Normal tax, interest plus late fee. On that amount, additionally, now I have to pay 25% extra. But if you file, sir, now which assessment year I am speaking here? Regarding assessment year 21-22. But if you want to file assessment year 2021 return, then interest at the rate 50%. Now within 12 months, if I file interest 25%, that means till this 31st March, it will be 25%. Regarding assessment year 21-22. Assessment year 21-22, if I file after March, then what happens? 50% additional tax. That means 48,800 we thought, no sir, that 48,800 into 50% comes to 24,400. Additionally we have to pay. Okay. Now if we see simply in our practical manner, now if you file, sir, today in this May month, if you file assessment year 2021, you have to pay additionally 50%. If you file assessment year 21-22, you have to pay additionally 25%. Because here if you see, if you file within 12 months, if you file between 12 to 24 months, sir, this months count from which month? From the end of the relevant assessment year. Assessment year 2021 means by 31st March 2022 itself, 12 months is completed. Now I am filing means in 14th month I am filing. So for assessment year 2021, 50% additional tax you need to pay. And for assessment year 21-22, 25% additional tax we need to pay. Sir, what do you mean by the term additional tax we are saying? Okay. So additionally tax only, but the term that was used here is interest. Interest at the rate 25%. On what item we need to add interest, sir? Let me show you one topic here. Yeah. First, let me discuss this 9th point, sir, and then I will go back. First, let me discuss this 9th point, and then I will go back. So here, if you see, payable tax, that means normal tax plus interest plus late fee. That's what I have done in my example. If you remember, normal tax 33,800 plus interest. Sir, any doubts if you have in the session that I am discussing, you can post in the chat box, or else at the end of the session, I will give you a time to have a discussion on the aspects that the doubts, if you have, you can present it there, or else in the meanwhile, you can share it in the chat box. I will clarify at the end of the session. Payable tax plus interest plus late fee. That means in my example, 33,800 plus interest 10,000 I have assumed, payable fees 5,000, total 48,800 into this is called as the additional tax. This is called as the additional tax. On this amount, this is the total tax liability. On this total tax liability, what we need to say? Additional tax at the rate, how much, sir? 25% we need to pay on the total tax liability. 25% we need to pay. Okay. And next, if we file between 12 to 20, in the meanwhile, one thing to be remembered here is already the taxes which we have paid, we need to reduce. Out of the total tax liability here, we get 43,000. If I pay any advance tax or any TDS or TCS or regular taxes that I need to reduce, then I will get the net tax liability. This net tax liability, on this net tax liability, I have to pay 50% additional tax. If I file between 12 to 24, if I file within 12 months, 25% additional tax should be paid. So this is the additional burden, since the government has given option to file, so that many cases cannot be selected for scrutiny, because due to introduction of this TAS and AAS, the lot of information is with the department. For all the SSCs, rather than giving notice, income escaping assessment notice, it's better to give option once again to the SSCs and make them to pay additional taxes. Still, if they don't pay, then we can commence income escaping assessment proceedings. So keeping that in mind, what the department has done is this updated return concept has come into existence. Sir, this updated return, what is the form? ITRU. Let me show you the form. Yeah. Yeah, this is a form called ITRU. So maximum within 24 months from the end of the relevant assessment year, you need to file. This is the form notified ITRU. Very simple return, only 4-page return has been given here. If you see here, page 1, page 2, page 3, page 4, that's it. 4th page is also just verification page. That means hardly speaking, only 3 pages written. This is very simply they have given that 5 heads of income, summary you present, that's enough. 5 heads of income, summary, what is the additional income you need to disclose? Whatever the additional income you are trying to disclose, that you can disclose. Sir, only additional income. Whatever you have already disclosed in original return, that you need not disclose here. Only additional income is enough to disclose. So total income as per last valid return. That means already you have filed the return. No? If you didn't file return, entire amount is the additional income. Sir, here let's take one example. Already under head PGBP, already have filed original return. In that original return, my income is 10 lakhs. Whatever may be the head of income. My total income is 10 lakhs. Now, additionally in business head, I would like to show 2 more lakhs. Is it possible? Yes. Here, how much I need to write? Here you have to write 2 lakhs. Now, additionally in under business head, I would like to disclose 2 lakhs means here you need to write 2 lakhs. Earlier in return, total income, how much I have shown already in the return that I have filed 10 lakhs. Now, what is the total income you get here? 12 lakhs is your total income. On this 12 lakhs, what is the tax liability? That you need to write here. That means you have to make self-assessment yourself and write the amount payable. This is the total amount payable. Out of this total amount payable, what we need to reduce? Out of this total amount payable, already we have paid some self-assessment tax, TDS and TCS. No, that we need to reduce. And then comes the net tax liability. On that net tax liability, what we need to do? On that net tax liability, we have to pay additional tax, 25% if we file within 12 months, 50% if we file within 24 months. That's what has been specified. A simple return has been given here, sir. Updated return, only 4 pages written. So net amount payable, additional tax liability, if you see, on the out of the tax payable now, minus 5 plus 8. What is point number 5? In last IT return, how much I have already paid? How much is the regular assessment tax? Regular assessment tax means already in IT return that I have filed, how much tax I have paid, that they will reduce. Then you get the additional aggregate liability on additional income. On that additional income tax, you need to pay how much, sir? 25% or 50% as the case may be, we need to calculate. Then comes net amount payable, that we have to pay. That challan details we need to fill here. and file this return called updated return. So reliefs, rebates, any option available is also available here also. But here if you see, relief under section 89 is only given. Rebate under section 87A, can it be filed, can it be claimed here? Specifically, they didn't give any instruction. But here if you see, amount payable by us, we have to disclose. But of course, below 5 lakhs income case only, rebate under 87A is permissible, not for all the SCs. So that doubt does not arise to us. So here amount payable also, we need to directly specify the tax liability. Sir, if we have any special tax rates also, if you see on capital gains, we might have short term and long term. But here bifurcation is not given. Total short term capital gain, how much we have, here you disclose. Additional only, whatever you have disclosed in original return, that original return you have to give here. Your original return income should be given here. Whatever the additional incomes you disclose, that additional incomes only under this appropriate heads you need to disclose. Sir, under this head, whether any additional items we need to show? No. Directly whatever the income you would like to present additionally in that head, you disclose. Sir, clarifications department might ask later. For updated, first department should get the income, they should get the money, they should encourage the public to file the returns. Whatever they have, omissions earlier. So clarifications department might ask earlier. I'm not saying that it's sure that they will ask, sure that they will select the case for scrutiny. That's not the thing. So it is at the department side later, whatever they do. But now what we need to do is, whatever the income we have not disclosed properly, whatever we have omissions in the original return, those omissions only must be disclosed. That additional amount only you disclose. Plus total income we have already disclosed. Then comes the total income. This is the correct total income. Calculate tax liability, reduce the original tax which we have already paid. That net liability, we have to pay 50% additional tax. When we file within 24 months, within 12 months, if we file, you can pay only 25% additional tax liability. So this is the form called updated return. That's what we have discussed here. There is much more theory regarding this updated return. Let us have a discussion. Details to be mentioned. That's what now we have referred to details under prescribed income tax heads. Under prescribed income tax heads. That means it may be salary, it may be house property, it may be PGBP, capital gain. Under the prescribed heads, what is the income? Directly or respective heads, you add the income, additional income. No detailed income breakup. If you see capital gains, how much is the short term, how much is the long term, how much we have exemptions under section 54. Those each and every item you need not give here. Those each and every item you need not give here. So here what you need to give is what is the net amount, what is the net you need to increase, what is the net amount you are trying to disclose. That's what you need to state here. Okay. So coming to the next thing, how to verify a updated return. So once we file this updated return, of course, now practically in website, they have not given this updated return. PDF form is notified, but filing in ITR, income tax website is not yet enabled. In a short span, within 1 week, they might enable this one. After filing this updated return, how to verify e-verification. Tax audit cases only through digital signature, remaining all other cases EVC mandatory. Post of acknowledgement to CPC is not specified at all. We cannot post the acknowledgement. Signing, physically signing and posting is not possible. Here compulsorily what we need to do is we have to compulsorily attach through digital signature we can file. Remaining cases also if you want you can file through DS. Sir, this is normal IT only, can I file through digital signature? Yes. But tax audit cases it's mandatory. Others can file either through DSC or EVC. We cannot say that compulsorily EVC, either through DSC or EVC, all other cases. And one more thing, for political parties, they said it's mandatory DSC, but it's not useful for all the clients. Next. When you can't submit an updated return, who is not eligible to file this updated return? If the updated return is a loss, now you can't carry forward the loss. Because what I have said to you, Reducing the income tax liability is not possible. An updated return cannot be furnished. If you want to reduce the income tax liability, you cannot file this updated return. Or if you want additional refund, to increase your refund, can we file this updated return? No. It's not possible. Next. If the stretch has been started under section 132, if the stretch has been started under section 132, then stretch proceedings must be conducted. Now all the stretch proceedings will be converted into income escaping assessment. Now section 153A and 153C have been omitted from the act. With effect from 1/4/2021, so wherever the stretch has been initiated also, department issues income escaping assessment notice under 148. Now section 153A and 153C is not in existence at all. That amendment also I will discuss later, sir. There is one of the point in my discussion where the books of accounts has already been called for 132A to begin the stretch assessment. So whether any books of account has already been called, if any survey has been done, already the assessment is pending, scrutiny has been selected. After selecting scrutiny, so since my file has been selected for scrutiny, let me file updated return. Is it valid? No, it becomes invalid. Whoever has made violations under Money Laundering Act or any other person if government notifies. Till now, only these points only have been notified. These persons cannot file updated return. That means if our proceeding is pending for scrutiny or income escaping assessment, department has already commenced against us. If department has already commenced income escaping assessment against us, now can I file updated return? No, it's not possible. Already scrutiny has been selected under the 143(2). Now can I file this updated return? Not possible. Scrutiny is not selected, sir. Can I file this updated return? Yes, you can file. One of the best thing here is, even though you didn't file the return earlier, now you can file. Sir, whether with the zero tax liability can we file or not, that we have to wait and see whether the portal accepts. Generally, the theme here is to levy additional tax liability. If my income is below 5 lakhs, sir, earlier I didn't file. Now can I file this updated return? We have to wait and see whether the portal accepts zero taxes. That means whether rebate under 87A can I claim and file nil return so that I can get my ITR. Let us wait and see. But general theme which was specified in this updated return is additional tax liability must be paid. Okay. So next thing, additional by this we have completed the first topic, sir, and very, very useful in our practice. Updated income tax return. Wherever we have, because some clients usually comes at the end, whose audit we cannot do. But the due date and belated and time period is also completed. Later, if they come to us, now we have a wonderful option to file this updated return. But one thing to be noted, you file this updated return before you get the notice. Once the department already commences proceedings against us, we cannot file this updated return. This point I have already given here, sir, in this point number 8. If you see, already any proceeding of assessment, reassessment, revaluation is pending or completed in that year. If it is pending, then we can't come for this updated return concept. That's why before getting notice only, any violations you have done in the return, so get them rectified using this concept of updated return. How to calculate tax liability, just in 5th point itself I have explained to you. So by this we have completed the first topic, updated income tax return ITR. Any doubts you have, you can post it in the chat box, sir. Any doubt you have, you can post it in the chat box. I will clarify you. And one question has been raised here, whether the Sscp be allowed to file return if there is no taxable income. That's what I have said, sir. So if below 5 lakhs income, if you show, and whether can I file with zero tax this updated return, we have to wait and see whether the portal accepts. But general theme here is only if you pay additional tax liability, then only you can file this updated return. Only for additional tax liability payers only this updated return has. With zero tax, can we file or not? Let us wait and see whether the portal accepts. So next thing. Actually, forms have been notified, but in portal, filing has not been commenced yet. Next. And let us discuss further changes in ITR forms. Some changes in ITR forms. Before beginning the changes in ITR forms, one more trending aspect which has come on April 21st. One more trending aspect which has come on April 21st. Let me discuss that one first and then come to changes in ITR forms. So first of all, Rule 12AB. Generally 12AB is a trust registration no, that is section 12AB. But now I am discussing Rule 12AB. Of course, that section 12AB and Rule 12AB. So both are revenue generation for chartered accountants only. So section 12AB in case of trust, even though it is registered also, again we should get registration, provisional registration. Many aspects were given in that 12AB, section 12AB. But now I am discussing rule number 12AB. What is rule number 12AB? Mandatory filing of returns. Sir, in case of business, if your receipts is greater than 60 lakhs, that means our turnover exceeds 60 lakhs, compulsorily we have to file IT return. Even though my income is below basic exemption limit, even though my tax liability is nil also, if you have gross receipts in business greater than 60 lakhs, mandatory filing of returns. Gross receipts in profession, in case of profession, whenever your receipts exceeds 10 lakhs, you have to compulsorily file your returns. Next point here is the TDS or TCS, already TDS, TCS deducted is greater than or equal to 25,000. Generally TDS for the purpose of refund cases we file, but some SSCs do not bother at all regarding TDS or TCS. They will simply leave. I will not file return, I don't want refund also. Simply they will leave the TDS and TCS. If your TDS and TCS amount is greater than 25,000, you have to mandatorily file your returns. For senior citizens, that means 60 or more. If you have TDS or TCS greater than 50,000, you have to mandatorily file income tax. This notification 37/2022, which has come on April 21st, has given this aspect. And this is very, very useful. And to some extent, there is a dilemma in this point also. Savings account deposit greater than or equal to 50 lakhs. If a deposit in our savings account, sir, I have generally savings bank account. If you deposit cash deposit more than 10 lakhs, those transactions will get reflected in AIR, annual information statement. If you don't file returns, we are getting notice. But here mandatory, in which case they are saying your savings account, if your deposit is greater than 50 lakhs, then you have to mandatorily file this return. Even though your income is below basic exemption also, even though that is not your income, I have taken loans at 20,000 per person. For 20,000 out of 100 friends, I have borrowed 10,000 rupees per friend. Total, I have borrowed around 10 lakhs. That I have deposited in bank account, sir. Okay, whatever may be the case. Even though it is a low transaction or capital receipt, even though it's an exempted income also, even though you have only exempted income, but in your savings account, if you deposit greater than 50 lakhs, even though you are having agricultural income, you are required to file the returns here. You are required to file the returns. It's mandatory filing of returns in those cases. So now, since the one important aspect regarding filing of return has been dealt with, now let me come for other disclosures in ITR forms, other changes. First of all, in capital gains, the concept of date has been introduced. Earlier, date of purchase and date of sale, specifically we need not disclose. Even though in your softwares you might feed date of purchase and date of sale, but in ITR form, earlier, date of purchase and date of sale is not mandatory to disclose. But here, now, the date of purchase and date of sale, you might feel confused to some extent what I am discussing. That's why, let me show you. This is assessment year 21-22 ITR forms. ITR 3 I have taken as example. Assessment year 21-22. So here, let me come for capital gain once. Yeah, this is scheduled capital gains. And if you see, this is assessment year 20-23. This is scheduled capital gains. Okay. Sir, once again, this is assessment year 21-22. This is assessment year 22-23. Here we have date of purchase, date of sale. But here if you see, there is no such date here. Once again, I repeat, date of purchase, date of sale. In scheduled capital gain, we need to disclose. And this is assessment year 22-23. But for assessment year 21-22, the date of purchase, date of sale is not given here. In this assessment year, that was not given here in assessment 21-22. That is the first change. Data of purchase, data of sale should be shown so that the department can also see. Even 54 investments also, simply saying that I have invested in another building, that is not enough. There also you have to give data of purchase. In 54F, if you are purchasing a new residential house, there you need to compulsory disclose the date of purchase. Okay. Next. Sir, if we are selling foreign property, if we are resident in India, even though I sell the foreign properties also, the global income might be liable to tax. In such case, even the foreign country asset if you sell, that country name and zip code should be disclosed. Additional point has been come in case of foreign country assets if we sell, here that country code has to be written. Earlier that is not there, but now specifically they have written. And another amendment is in case of slump sale, that means amalgamations and demergers, if the conditions which were specified, there are some conditions specified in section 47, transactions that are not regarded as transfer. I repeat, transactions that are not regarded as transfer, for amalgamation and demerger, they have given some conditions. If they fulfill that conditions, it is not a transfer and no capital gain. But if they violate those conditions, it becomes slump sale and you are liable to pay tax. Section 50B has specified that the fair market value of the capital assets should be considered, or normal consideration, whichever is higher, should be taken as the full value of consideration. For example, amalgamation, company A has been purchased by company B for 500 crores. This is the actual consideration. But fair market value of assets is 600 crores, sir. Then for the purpose of calculating capital gains, 600 crores you have to pay. That means fair market value of capital assets or actual consideration received, whichever is higher, should be taken as the full value of consideration. Sir, how we have to compute fair market value? One rule has been given for fixed assets. For debtors, book value we consider. Fixed assets, some specific valuation method has been given. Stock valuation, each and every asset, how to make valuation has been given in this valuation rules, rule number UAE 11 UAE. Here they have given the procedure for computing the fair market value of the capital asset. Here they have given the procedure for computing the fair market value of the capital asset. That one or actual consideration received, whichever is higher, should be taken as the full value of consideration. The same thing has been notified in ITR form. In ITR form, if you see assessment year 22-23, section 50B slump sale. So in this slump sale, this additional point has come. Rule number 11 UAE, fair market value, fair market value. This fair market value or our actual consideration, that higher amount only should be taken as the full value of consideration. So this is the another change that has come here. Next, year-wise cost of improvement. Earlier, total cost of improvement we should disclose. Indexed cost of improvement. But year-wise, how much I have improved? Those aspects I need to show. And one more thing, cost of acquisition and indexed cost. Earlier, if you see, this is assessment year 21-22. In this, if you see, for long-term capital gain, let me show. Directly cost of acquisition with indexation. You compute your own in your own manner, you make self-assessment that indexed cost you write here. Cost of improvement also, indexed cost of improvement you write here. But now what they are asking, break up. Each year cost of acquisition and indexed cost, both should be given. Now if you see the same thing. Now if you see the same thing in long-term capital gain schedule. Yeah, here in long-term capital gain, if you see, cost of improvement, I need to disclose. On that, I need to disclose indexed cost. With indexation, how much? And before indexation, what is the cost of acquisition first? And then indexed cost of acquisition. First, cost of improvement, year of improvement, indexed cost of improvement. That means original and indexed. Both things you need to show. Earlier, directly summary was given here with indexation. What is the original cost? On which item you have done indexation? That amount is not given earlier. But now here, if you see, cost we have to show, indexation we need to show. Cost we need to show, year of improvement, and then indexation. That means some more particulars they are asking. Next, coming to the next amendment, 222E, deemed dividend for closely held companies. That means for private companies or unlisted public companies, they will be called as closely held companies. Those closely held company, if you give loan or advance to a shareholder who is having a 10% voting power, minimum 10% voting power shareholder, if you give any loan or advance, then the concept of deemed dividend under section 222E will come into existence. Equal to the amount of dividend, we have to show income under the head other sources. In that other sources, now specifically, what is the 222E dividend you need to show? What is the 222E dividend? Specifically, you need to show. Because on this 222E dividend, you have to pay normal liability, but advance tax liability does not attract because we don't know the accumulated profit of the company. Initially, we don't know because to the extent of accumulated profit only, it will be regarded as the dividend income. That's why separately you show normal dividend in one column, 222E dividend you showed separately. Because in advance tax calculation, this we should not calculate because we don't know what is the accumulated profit of the company. After the end of the year, based on respective date, we need to see. That's why 222E dividend, separate disclosure they have. Normal dividend you disclose separately, 222E dividend you disclose separately. And this amendment is useful for many of the chartered accountants in practice. Provident fund interest is exempted earlier. Recognized provident fund or statutory provident fund, whatever may be the type of provident fund, except unrecognized provident funds or even PPF also. PPF exempted, statutory provident fund exempted, but interest accrued on the contributions, both on employer and also employee contributions. On those contributions, interest is earlier fully exempted. But now, if your contribution is greater than 2,50,000, on that excess contribution, interest accrued will be taxable. That means full interest is not exempted. Sir, if I contribute yearly 2 lakhs, then can I get exemption? Yes. If I contribute 3 lakhs to the provident fund, then what I need to do, sir? If you contribute 3 lakhs to the provident fund, then first 2,50,000, the contribution you have given, that we have to consider as provident fund 1. Additional amount 50,000 also you have deposited. No, that you say it as provident fund 2. That has been given in this rule 9D. What rule 9D has specified? Since contribution over 2,50,000, interest will be taxable under the head other sources. Sir, provident fund I have contributed 3 lakhs. Okay. Next year, if I get interest on that 3 lakhs, interest you receive on 50,000 will only be taxable. Interest received on first 2,50,000 is exempt. Sir, I am speaking regarding interest received. Interest accrued on the provident fund, whether it is exempted, earlier fully exempted. But now contribution over 2,50,000 will be taxable. Whether contribution is taxable? No, interest received on that contribution. That interest accrued on contribution exceeding 2,50,000. For that purpose, government has clarified in rule number 90 that you categorize them into 2 funds. Sir, if I contribute 3,50,000, then what I need to do? First 2,50,000, this is provident fund 1. Next 1 lakh, over and above 2,50,000, I have contributed 1 lakh. No? This 1 lakh you say provident fund 2. On this provident fund 2 accrued interest, you are liable to pay tax liability and they will deduct TDS also. And that will be taxable under the head schedule other sources. That item you need to disclose separately. A separate point has been given regarding this provident fund interest, there you need to disclose. And if employer does not contribute, that means like PPF. In PPF, no employer contributes. Employee on his own, he will pay. Persons. In such case, up to 5 lakhs contribution, nothing is taxable. If I contribute 5,50,000, first 5 lakhs will be Provident Fund 1. Next 50,000 will be Provident Fund 2. On this Provident Fund 2, how much interest we get, that interest will be taxable. Sir, I am not telling regarding contribution, sir. What will be taxable in future? Interest accrued only will be taxable. Over and above 2,50,000. If employer does not contribute, interest accrued on contributions over and above 5 lakhs will be taxed. So mode of computation is given in Rule 9D. That's what I have explained. Categorize them into 2 Provident Fund. Provident Fund 1, Provident Fund 2. Provident Fund 2, the excess amount you calculate under Provident Fund 2. Interest accrued on that Provident Fund 2 will be taxable. Next. Coming to topic number 5, amendment number 5. Unabsorbed depreciation. This aspect we have from initial Income Tax Act itself. Now, what is the special point I would like to discuss to you here is, sir, material, some were asking, okay, material has already shared initially, but now once again, I am sharing the material in the chat box. So anyone want, you can use it. I have shared the material just now in chat box. You can see after 30 seconds, it will be visible there. So coming to the next thing, adjustment of unabsorbed depreciation. Okay, this was regarding 115 BAC. What is 115 BAC? In last assessment year 21-22, this concept has come, sir. Old and new tax regimes. Under two regimes, we can calculate the tax liability. So whichever is beneficial, SC can opt. That means by claiming deductions, old tax regime, without claiming deductions, new tax regime. Both we are calculating. Usually wherever we get less liability, that we are opting. If you opt that 115 BAC, and if you have any unabsorbed depreciation, then what we need to do, that unabsorbed depreciation, now you can't claim. That is one of the main conditions. There are additional depreciations and unabsorbed depreciation cannot be claimed in section 115 BAC. That's why that carry forward unabsorbed depreciation, you add to the block and claim normal depreciation. Shall be increased by the amount of unabsorbed depreciation. Block as on 1/4/2020 shall be increased by the unabsorbed depreciation. Sir, this date is already completed now. Assessment year 21-22 returns also. We have already filed assessment year 21-22 returns. Then now why are you asking again regarding this aspect? Already we have filed assessment year 21-22 returns now. So, sir, even though you have filed that year, I didn't opt. In that year, I didn't opt that section, sir. That means under old tax regime, I have paid. Now can I come for new tax regime? Yes, you can come for new tax regime. And once you come to new tax regime, can I opt out? For business SCs, one-time option is given to opt out, but again you can't opt in. But for other SSEs, other than business income, you can opt in, opt out, opt in, opt out, it's your wish. But business SCs, only one-time option is given. Once you opt in, once you have option to get opt out, but again you can't opt in again. That means only one-time option has been given. So now in this year, sir, in assessment year 21-22, I have paid normal tax regime only. Now in assessment year 22-23, can I come for this new tax regime? Yes, I can come. And if I have unabsorbed depreciation, that I have to add to the block, that additional amount separately you have to disclose in a ITR form. Earlier separately we didn't have column, but now a separate column has been given. Unabsorbed depreciation pertaining to section 115 BAC. Unabsorbed depreciation pertaining to section 115 BAC. Now they have specifically given a column in new ITR form. Next, even in case of cooperative societies also, without claiming ATP deduction, they have section 115 BAD. Like for us, we have 115 BAC. For cooperative societies, 115 BAD is given. There also unabsorbed depreciation that we can't set it off now. We have to add it to the block. Next. limiting the rate of surcharge on dividend income. Sir, on dividend income, surcharge has been reduced. Generally, surcharge when we need to pay, whenever our total income, in case of individuals, here if you see, for individuals, HUF, AOP, BOI, AJP, generally, when we pay surcharge, sir, greater than 5 lakhs, sorry, 50 lakhs, total income greater than 50 lakhs. So 50 lakhs to 1 crore, we pay 10%. 1 crore to 2 crore, we pay 15%. 2 crore to 5 crores, so we pay another percentage. Above 5 crores, if we have total income, we pay highest surcharge. So normal taxes we are paying, along with that additional surcharge, 37% is being levied. So greater than 5 crores, 2 to 5 crores, we have 25%, like that. Many options we have regarding surcharge. But on dividend income, sir, if my income is greater than 1 crore, so surcharge percentage, what is the surcharge percentage? 15%. But whenever my income is greater than 1 crore, on entire dividend income, surcharge should be restricted to 15%. Generally, if my income is 6 crores, higher surcharge will be charged. But here, surcharge should be restricted to 15%, not 37% on dividend income. Only on dividend income, sir. Only on dividend income. Sir, below 50 lakhs income, no surcharge at all. 50 lakhs to 1 crore, how much is the surcharge rate? 10%. Greater than 1 crore, 15% is only the maximum surcharge. On which income? On dividend income only they are specified. On remaining all other incomes, you have to pay higher taxes. So the surcharge on dividend has been given one restriction. That's what we have discussed there. Next. For company SSEs, sir, for company SSEs, and not only for companies, even for proprietors also. Dividend income, we tax the dividend income under the head other sources. But some SSEs, they write as income in P&L account. Some SSEs, they write this dividend as income in a P&L account. So for them, what they have specified here is that dividend income must be excluded. We have given a separate column in exclusions, schedule BP. Earlier, there is no separate column to exclude dividend, but now specifically, dividend you have to exclude in schedule BP and write it under the head income from other source. Even though shares are held as stock in trade also, the dividend income should be shown under other sources only. It is a rule. Even though it's a stock in trade also shares, but the dividend income should be reported under the head income from other sources. You have to reduce here and report it under the head income from other sources. Now here comes one more very, very important thing, sir. 153A and 153C has been deleted. Even in our Idr forms also, we select section 139.1, original return, 139.4, belated return, 139.3, loss return, 139.5, revised return, 148, income escaping assessment return. But now, earlier there is 153A, stretch IT, 153C, stretch in other premises. There, if our documents were found, we should also file it. We also come under stretch assessment. That is 153C, assessment on other persons. So these two sections also we earlier have filed last 6 assessment years. Whenever a case is selected for such assessment, past 6 assessment year returns, we need to file again using section 153A and 153C. But now that one also has been removed. Because now stretch assessment, even though stretch is conducted on or after 1/4/2021, all the stretch has come under sunset. That means even though stretch has been conducted also, those stretch assessment proceedings have come under 148. That means income escaping assessment only they need to issue. Even the case is selected for stretch assessment also, we have to commit under income escaping assessment only. That means now 153A and 153C is not there. Now only 148 income escaping assessment only. Even though the department search has been initiated on or after 1/4/2021, any discrepancies found, 148 income escaping assessment notice. Using that 148 section, now we will file the return. Now, one more very, very important thing I would like to give you clarification, which is very, very useful to all the chartered accountants in practice. Now, we are getting 148A intimation before notice. First of all, reasons for before commencing income escaping assessment, department were initially specifying the reasons. Earlier in 148 notice, they don't specify reasons. But now, before notice, inquiry they are conducting. 148A they are issuing. When the department has right 148A budget, they have clearly clarified that greater than 50 lakhs escaped income only, then only they have to come under 148 assessment. Below 50 lakhs also they are converting into income escaping assessment, sir. That assessment is invalid. You can question them. So greater than 50 lakhs escaped income is there, then only income escaping assessment proceeding should be commenced. Okay. So now, what is the amendment, sir? 153A and 153C have been deleted. Now only 148 is there. Even though stretch is initiated also, 148 section only we filed the reports. So in new forms, 153 and 153C have been removed because those sections are removed. Those sections were merged with 148. That's why Idr form is also modified. Next, alternate tax regime. That we say new tax regime, old tax regime, new tax regime. We usually say no. Now I am speaking regarding the new tax regime. So in this new tax regime, sir, last year I didn't opt. Now can I opt? Yes. That's why new columns have been added. Whether you are opting now or now you are not opting or you continue to opt. Sir, opting in now means now fresh. In assessment year 22-23 only I am opting. Not opting means this year also I will go to old scheme only. Continue to opt means last year I have opted. Now also I am continuing the new tax regime. Opt out means I am coming out of last year I have opted a new tax regime. Now again I want old tax regime only. I am opting out. These 4 options have been notified, sir, regarding 115 BAC, alternate tax regime, 15% slab, 20% slab is there, no? Regarding that alternate, we usually call it as new tax regime. In that new tax regime schedule, we have 4 points here. Whether now you are opting or you are not opting in this year also, or last year you have opted, or now also you are continuing, or last year I have opted, now if you want to opt out, those options, again, out of 4 of these, any 1 point you have to tick. For our regular kinds, we tick this one. We follow old tax regime. No, sir, now we would like to opt, here you tick. So that option have been given there. So based on that, we have to consider. Okay. Now let us continue. And this amendment number 10 regarding mandatory filing of returns, I have already discussed to you regarding mandatory filing of returns. So by this, the aspect mandatory filing deposit in savings account greater than 50 lakhs, gross receipts greater than gross receipts greater than 60 lakhs. In case of profession, gross receipts greater than 10 lakhs. So these cases, mandatory filing of return, I have already discussed in the initial decision initially only. So by this, all the amendments which have been come from the past 2-3 months, I have had a complete discussion to you. So now let me solve the queries which were raised in the chat box. Sir, anyone, if you are having queries, we can put it in the chat box. Now I would like to clarify to you. So already some have raised the queries. Let me begin one by one. So first one is, will the SSC
that is already a e-competition. Correct. The opportunity, the free award for the Baga next for the and just in the success. All the very best.
Sir, actually, Sudhir Garu, what has happened is I have enabled to unmute themselves. Give me a second, sir. I will disable the voice. Right, sir. Sorry for that. Actually, what has happened is since the Q&A session has commenced in security, what I have done is enabled unmute themselves. Fine. Please go on, sir.
Yes, sir. So first, let me clarify the doubts that have been raised here. Whether original valid return filed under section 115 BAC. G. Gangadhar Garu has put this question. When original return is filed under section 115 BAC, whether an updated return can still be filed under 115 BAC. Yes, sir. In original return, you have opted 115 BAC. Now also you can opt the same thing, 115 BAC only. Because now in updated return, if you see the tax liability column, we have to fill on our own. It's not pre-filled. In original IT, special tax rates incomes, original incomes, separately we disclose normal incomes and special tax rate incomes. But here in this updated return, separate columns were not given. So what we need to do is we have to calculate. If you have opted only, sir, earlier I didn't opt. Now can I opt 115 BAC under this updated return? That is not possible. Original return you have to opt 115 BAC. Now in updated return also we have to file using 115 BAC. Next. Will the Sscp be allowed to file returns even though there is no taxable income? I hope so, sir, because we have to wait and see till the forms were notified. If your income is below 5 lakhs, I want to disclose only 4 lakhs income, sir, for individual. Nil tax liability. Now can I file this updated return? I hope so that option would be enabled. But actual theme, what I have said to you is to pay additional taxes. When there is no tax liability, can we file this or not? Let's wait and see. I think so, it will be accepted. Next. Sir, towards P.R. Venkatramana Garu has raised a query that, sir, towards Provident Fund contribution, whether the limit is per annum or outstanding balance at the end of the year. Yeah, very good question, sir. Per annum, sir, this limit. This limit is per annum. 2,50,000 limit I have given, no, sir. That is per annum, not on the outstanding balance. Sir. Every year I contribute 2 lakhs per annum. Now, whether tax liability arises? No. Every year, if I contribute 3 lakhs per annum, whether tax liability arises? Yes. Additionally on 50,000, whatever the additional interest you get, that interest would be liable to tax. So that limit is per annum, sir, not cumulative. Okay. Next, regarding material, once again they are asking. Already I have put it in the chat box, sir. So once again I am trying to share it to you, so you can use it. Next, sir, what happens when tax liability reduced due to change of head of income? Yeah, one more question R. Venkatramana has put here that what happens when tax liability is reduced due to change in head of income? Then you can't come to this updated return. If your liability is going to get reduced, then you should not opt this updated return at all. So I think it's very clear. In such cases, we should not opt this updated return. Okay. And next one. Sir, what happens okay, if we opt out 115 BAC, we have to file withdrawal form also. Yes. Next. In slump sale, whether the fixed assets of the company should be valued as per 11 UAE or what should be done? Yes, sir. Now, what they have specified is in case of slump sale, fair market value or your actual consideration, whichever is higher, should be taken as the full value of consideration. So assets must be valued using 115 UAE. But regarding fixed assets, are very simple process they have given there. In case of depreciation, WDV, they have given there simply fair market value. You have to go for valuation aspect there using that rule. Cost of acquisition, it's very simple. Depreciable assets, WDV. Non-depreciable assets, book value. But full value of consideration, fair market value, sir, you have to follow valuation principles which were given in section 11 UAE. Next, if Provident Fund contribution is per annum, interest is taxable every year. Yes, sir. Here interest accrued will be taxable, not received. In case of Provident Fund, interest accrued will be taxable. That's why we have to maintain our ledger in excess of 2,50,000. Whatever we contribute, that we have to treat it as Provident Fund 2. On that provident fund to accrued interest, it may be 8.5%, 12%, 15%, whatever may be. On that interest should be disclosed under the head income from other sources, and we have to pay the normal tax. Yeah, the queries which were being raised here were being solved, sir. Any other queries you can put in chat box? Yes, sir. Ravi Kishore Garu, the queries which were raised have been solved. Let's wait for a while. Any other thing if they ask?
Yeah, of course, PPT was already shared, sir. Dilip sir,
Yes.
PPT was already shared. So, Sudhir Garu, if you can please share once again the PPT, sir, in the
Yes, sir.
chat box.
Yes, sir. I have shared once again now.
Right. What I will do is I will once again allow the participant to unmute themselves, and if you have any query, you can directly ask. Yeah. Now voice is enabled for everyone. Please, any one of you, if you want to pose a query to the speaker, you are most welcome. So, Sudhir Garu, in the meantime, if we may discuss by this month end, I think we need to also comply with the provisions of form number 61A. That has to be done by this month end, and also the TDS returns are to be filed. The due date for filing the TDS return is also fast approaching in this month. So all these compliances have to be made by this month end, and also for LLP form. An LLP form is also to be filed by this month end.
Yeah. So by 15th of this month, we have to file TCS returns, and by month end, by May 31st, we have to complete the TDS returns. And form 61A regarding statement of financial transactions. So if we have any of the transactions which were notified in statement of financial transactions, those aspects generally for our tax audit SC, in case of receipts from the customer in excess of 2 lakhs, whenever we receive in excess of 2 lakhs, those aspects must be disclosed in form 61A. Remaining all other compliances usually will be for banks and NBFCs, but from our case, those aspects we need to submit, or else a nil return also we can submit when there are no transactions. So nil return also can be submitted.
Yes, sir. Yeah, if you have already applied for ITDRN, then you can only log in, and then you can file the nil statement, or else you can also file a statement stating that you are not liable to file that return by marking not applicable or nil. That statement can also be filed, sir. But if you are not applied for ITDRN, what you can do is in the CPC login of the SSC itself, there is a menu option wherein you can file this statement of that no transactions have been entered. So I think we ran out of the queries, Sudhir Garu, for now.
Yeah, we have given sufficient time.
Yes, sir. And Chairperson, Madam Shrita Shirin, are you in there? Right, sir. So, Sudhir Garu, thank you very much for coming to this VCM as a speaker, and also the way in which you have explained that ITRU. I don't think one can expect a better explanation than the one you have given. So all of us have become your students for some time in understanding what is that ITRU. It was in a very comprehensive manner. So over to the chairperson, madam, for her closing remarks.
Sorry, sir. Thank you, Sudhir sir. Sudhir sir, as I said in my opening remarks, sir, your presentation is in such a easy, understandable way, and you have taken up all the points of amended ITR and explained in such a way that our members helped our members to understand the concepts like how to file ITR2 and other important concepts. Thank you, Anand. Thank you, Sudhir garu, and thank you, Anand.
Yeah, thank you, madam, for those closing remarks. Sudhir Garu, I think of late we have received a message from CA Potharaj Raghavendra. What he has posed is that an SSC is liable for tax audit. He did not get his books of accounts audited. Neither he got his books of accounts audited, nor he has filed the return of income. Now, whether that person is eligible to file ITRU.
Yeah, perfectly he is eligible to file.
Yeah, of course, he can file the ITRU and he can extinguish the liability towards the tax and the penalties. But as far as the tax audit is concerned, I think the penal provisions as far as non-compliance of 44AB may continue.
271B penalty, 0.5% of turnover or 1,50,000, whichever is higher might be imposed.
Yes. So, Raghavendra Garu, are you satisfied with the answer, or do you have something more to add to that? Right. So, Sudhir Garu, thank you very much. Friends, before we sign off, we have a programming note on 10th, 11th, and 12th. We are, let me share the screen. Let me share the screen. It will be a better idea. Right. Now, all the branches of Andhra Pradesh, what they are doing is they are jointly hosting a program on real estate transactions. It will be on 10th, 11th, and 12th. On 10th, the real estate transactions in the point of view of RERA will be discussed. On the next day, the income tax perspective for real estate transactions will be discussed. And on the 12th of this month, the GST aspects will be discussed. And for this, on 10th, we have Dr. Rajkumar Satyanarayana Adukia ji, who is a Central Council member, and who is also currently the chairman of a CPE committee of head office. We will also be joined by a member of AP RERA, Mr. Chandu Samsevara, and also on 11th we will be joined by C. Abhishek Murali, who is a renowned speaker and faculty, and he was the past secretary of SIRC also. And we have this GST facet will be dealt by C.S. Sangu Ramakrishna. Friends, if you are an ARS member of Vijayawada branch, the fees for these seminars is nil. And if you are not an ARS member, we suggest that you please subscribe for this VCMs and get the knowledge or update about these real estate transactions, both in RERA facet, income tax facet, and GST facet. For now, thank you very much.